Passive investing has historically been more associated with equities than with fixed income. Some say that the bond markets are fundamentally more suited to active management. However, more recent data indicates that a change could be in the winds. So, what might the fixed income markets learn from the half-century story of growth in passive equities? And what do our SPIVA scorecards have to tell us about the current environment for index and active in bonds? Hello, I'm Tim Edwards of S&P Dow Jones Indices, and I'm joined by my colleague Anu Ganti to explore fixed income's passive potential and what Aesop's famous fable about the hare and the tortoise has to do with it. Thanks for joining me today, Anu.
Absolutely, it's great to be here.
So first off, why the hare and the tortoise?
It's a great question because if you think about this analogy, there's so many different ways to interpret this. And I'll give you a couple of examples. One is you can think of equities as the hare and fixed income as the tortoise. Another way to think about it is you think of active as the hare and passive as the tortoise, right? And you put those together. And when we started out producing this paper, we knew that indexing in fixed income came later to fixed income than in equities. But what was surprising to us was looking at the growth rate of indexing in fixed income. Because if you look at it over the past 10 years, the growth has actually outpaced that of equities, which is pretty fascinating to think about. And coming back to the analogy of the hare and the tortoise, we know how the race ended, that the tortoise won the race at the end by sticking to its goal. So we'll be watching to see if that is the case for indexing in fixed income, because there's plenty of potential here for future growth.
So starting slowly, but maybe steadily getting slightly closer at least. I mean, the fixed income markets are very different overall. There are differences when you look at the relative potential advantages of active and passive investing. It just highlights what are the main differences or the differences that you looked at in terms of equities versus fixed income.
So when you think about an active approach, right, and the reasons to pursue an active approach, there are some similarities when looking at equities and when looking at fixed income. And some of the common arguments are mitigating risk, reducing benchmark concentration, perhaps the ability to take outside benchmark tilts. These are all reasons that we hear that apply to equities and fixed income. But there are some unique features and differences, as you mentioned, for fixed income. One obvious one is when you look at fixed income indices, they tend to be a lot broader, a lot less concentrated, which means we see a lot of replication, a lot of sampling going on where you're not going to own all the securities.
You literally can't own all the bones in the index.
There's thousands of them. So to that point, I think benchmark replication, while difficult due to technology advances over the past couple of decades, we've now seen that it is indeed possible to replicate an index and to do so net of trading costs. So I think that's one of the advantages to think about. Another couple of differences that we found in the paper is just thinking about market cap weighting in bonds, right? Which initially at first glance may not seem like the best idea, but I think there's more going on under the hood when you think about market cap weighting, which is important to distinguish between size versus creditworthiness. And we saw that in our research. And as you know, there's a lot of unique benefits to market cap weighting, which is it's a lot more than just size. It also factors in the market's perception of an issuer and how trustworthy that issuer is. So that's one difference. And a final subtle point that I'd like to make is we know about skewness within equities. In our research, we know that outperformance tends to be driven by a few stocks, a few winners. Not the case with bonds, as we know that bonds are negatively skewed, where the most I'm going to get back at maturity is the repayment of my principal and a yield. But on the way, there's opportunity to lose both. But does that mean that an active approach is more appropriate for fixed income? We think there's more going on there in the research. So we still believe there's the case for diversification in fixed income as well as equities.
So we introduced fixed income categories into our global SPIVA scorecards over the past couple of years. What does SPIVA tell us about fixed income and active management, and what conclusions can we draw from that?
Sure. So SPIVA stands for S&P Indices versus Active. We've been producing this scorecard for more than 20 years across regions, and we didn't always report on fixed income, as you know, and you say that in order to report performance versus a benchmark, first you need a benchmark, and we didn't always have that. So now we have the availability of fixed income indices, so we're able to report on fixed income active underperformance rates. And we do this across regions. And the results are striking. If you look over a 15-year period, roughly 80% of investment grade and high yield managers underperformed. Very consistent results in Europe and across regions, which ties into all the arguments to support indexing that we were talking about earlier in our fixed income research. So I think that's the important thing to think about SPIVA, fixed income indexing, the reporting of underperformance rates, which is so important in our research.
So the hare and the tortoise, deep dive, if you like, into sort of the case for an indexed approach in bonds and a bit of a survey of the long-term data. That's published. What's next?
Yes, and just going back on that point, I would like to say that the results are striking, especially when thinking about alpha and the potential sources of alpha. For example, if you think about retail investors, their ownership of individual bonds has been declining for decades. If you look at central banks, for example, they may be purchasing bonds for policy decisions. But just because you have these potential sources of alpha, the game hasn't always been easy for active fixed income investors. So I think as far as future research, we'd like to go further, looking at alpha, looking at sources of alpha, distinguishing alpha versus style bias, which is another area of our research. And historically, we've seen that investment grade managers tended to do better when high yield was outperforming and vice versa. So we'd like to disentangle those two and look at that further. Another area is we'd like to just think about the sources of returns. I like to think of them as different levers that you can pull. You can look at credit, for example. You can take on more credit risk. You can take on more duration or interest rate risk. You can take on more illiquidity exposures. And speaking of liquidity, there's so much that we can look at in the liquidity space now that we have our iBox liquidity indices and the tradable ecosystem going with that. So a lot more to look at, looking at bid-ask spreads over time, especially during times of stress. And one final point I'll make is if you look at these spreads on the tradable vehicles, we found that they're actually lower than the individual bonds comprising the indices, which really highlights the potential liquidity advantages, trade efficiency advantages of these index trackers.
I think that point, the sort of liquidity aspect is super interesting because you do have, index funds, ETFs, but tradable products tracking indices. And actually what we observe is that these products, these index-based products, are being used quite actively. We've had futures launched tracking the iBox indices, and so it's not so much active versus passive, but what are you active with?
Correct. Absolutely. And there's so many different ways to gain exposures now, and we'll continue to see the evolution of indexing within the fixed income space.
Well, I look forward to it. Thank you very much for joining us, Anu. To learn more about the growth of passive in fixed income, to read our latest research and to explore our latest SPIVA scorecards, please visit us at the link below.